we're staring at some weakness for our markets, understandable given the sort of weakness that we saw in the Asian markets itself and the sort of rally that we've seen earlier as well. The good part, however, is that we are holding on to the lows and not falling further. The question that needs to get answered in the second half of trade is whether this dip will be bought into or not, because unlike the previous few days, the mid-cap index at an index level is outperforming, notwithstanding more stocks which are declining than advancing.
Hi, Mangalam. Yes, absolutely. And, it has died down in terms of global cues as well at this point in time. So maybe there will be just a little bit of a breather. We do have Thanksgiving in the US this week. And hence, the US markets are going to be closed on Thursday. They are working only till 1 p.m. on Friday. So you can see that there is a little bit of softness and dullness which is coming in terms of firm macro cues, at least for the markets at this point in time. But don't worry, we do have the RBI policy, which is in the first week of December. So we will be focusing on that. We have a lot of CPI data from a lot of markets globally this week as well. But nonetheless, let's talk about the first company which is on our radar. Jindal Worldwide is the first company that we're tracking this morning. The stock, in fact, has been buzzing in trade lately. It's up over 87% just in the past 1 year. So it's been quite a rank outperformer. To discuss the company's latest expansion plans and any likely impact of the rupee depreciation and global recession fears, we have with us Gaurav Davda, who's the head of corporate finance and strategic initiatives at Jindal Worldwide. Mr. Davda, hi, welcome to the show. Well, I'm going to start by asking you about demand indicators both in the export markets as well as in the domestic markets. The reason I ask is in the domestic market, we just got done with a big festive season, and the export markets are actually going into the festive season, though you might have already got an indication of demand maybe a couple of months ago. Give us what the demand indicators are from both the markets. Which market are you seeing outperform at this point in time, and the growth estimates as well?
So firstly, thanks for inviting me. Yes, the demand has been, a little soft, both domestically as well as overseas. But as you correctly pointed out, demand is looking up in both the markets. We are going into the festive season overseas, so that is a big boost for the export business, which did take a beating, because of geopolitical concerns and various other factors in the West. And domestically, again, we've, as you said, it's always seasonally a weakish quarter for the textile business, and which is why you would have seen a dampness in the numbers. But having said that, the demand drivers are very, very strong. Cotton seems to have stabilized. Global demand seems to be coming back. Dislocations in supply chains globally have actually eased out considerably, and I think Q3 and Q4 are looking really good, on both fronts.
It's interesting, and that also, I'm presuming, means that you will meet your guidance of 2,300 to 2,400 crore of revenue in this year, with about 31 to 32% contribution from exports. Is that correct?
I think ballpark we should be there. I think the export number may have a little bit of a fluctuation given Q2, but largely we should be on track to do that. Yes, with of course improving margins as is a recent quarter.
Be able to quantify the fluctuation that you are likely to witness in the export figure?
So I think exports should stabilize around 25% of our top line.
Okay. Give us a sense in terms of the kind of capex which you have coming on stream.
So between current financial year and next, we've planned about a 350 to 400 crore capex, half of which is already reflecting in our numbers. And that is primarily the reason also for the expansion in our margins. As you will see, they're at a 5-year high on the EBITDA and the PAT margins.
So then what are you guiding in terms of margins? Because in Q2 FY23, it was 12.8%. And we all know that there are variables, in terms of what's happening globally. But having said all of that, on a blended basis, what can you guide for?
I think we should be maintaining the margins between here and a couple of percentage points higher. That's safe to assume that we should be able to manage that in the current financial position.
To 15%, do you go up to 18%? What's a range at least?
No, that's really aggressive. I think 18% is, I mean, we'd be really happy to achieve that, but that's really aggressive for this year. But as I said, having said that, we are at a 5-year high. 12 to 15% is broadly what we have been aiming for. We're, at the bottom end of that. And we hope that we will meet the upper end of that, in this year and next.
All right, take that point. Just before we move on to the other business, you haven't taken further price hikes in the second quarter and now, right?
No, it's been tough actually to take price hikes because cotton has come down. Buyers are delaying purchase decisions, hoping to get a better price in the market if they delay their decisions. So in an environment where raw material prices are coming down, it's really difficult to take price hikes.
Right. And now to the exciting bit, the electric business. And I see that smile on your face. You said that 3 new models will be announced by the end of this year. I mean, how far are you in that? Any sort of order bookings that you can give us a visibility into?
So, yes, that's really an exciting initiative for the group. We hope to commercialize production sometime in Q1 of FY24. You will see our vehicles out on the streets. And we hope to, launch the pre-bookings sometime in Q4 of the current fiscal.
Okay. You had acquired a company some time back, which was, I think, earlier in the in May of 2022. Can you just tell us how that particular company, Earth Energy, is performing at this point in time? Any more acquisitions in the pipeline? What have you set aside in terms of, say, inorganic plans to scale up?
So actually, that was our, platform to launch our EV business. Actually, with that came up, very good talent and a lot of prototypes that have been developed by that team. We're building on what they had already built upon. There's no real major acquisitions in the pipeline. I think we're very focused in what we're offering, and we're hoping to stabilize what we've acquired, build on that, do a commercial launch, and then take it from there.
How much cash or how much capex do you have set aside in terms of, say, investment within the EV space, and what can we expect?
So as I had mentioned last time, I think about, in the immediate future between now and next year, near about 150 odd crores is what we envisage to invest in that business outside of the capex that we have anyway earmarked for our textiles.
And your spinning subsidiary, in which you are, earmarking about 250 crores in terms of investment, I presume this would be a backward integration for you, or would you, sell outside of what you consume as well?
So again, it's opportunistic, but yeah, the primary aim is to become, higher self-sufficiency on the backwards, spinning side. For the simple reason that we are seeing that, given the scale of our business, it's better to have a larger, captive capacity. And as and when required, if seasonality hits us, if demand slowdown, is there, we would like to maintain a good balance. And yes, we will assess, selling to the third party, but primarily it is for captive.
Right. So how much does it cover for your overall consumption, and what does it mean in terms of cost savings? If you could give us some sense of numbers.
Well, I can definitely share with you that in terms of backward integration, we would be at about 60-65% of our spinning requirement post this completion of this, this capex will be captive and in-house, which is a fair, balance to account for any fluctuations in demand going forward. Cost savings is very evident, as you can see. Margins have moved from 8% to 12%. So that's a very clear indication that, at the immediate onset of the first phase of our capex, we're already seeing an expansion in margins, despite, lower revenues and lower pricing because of the global situation. But difficult to put a very specific number on a per meter overall basis. But I think, conservatively, if you see our ROE, ROC is, we're at 20+%, and that clearly shows that, getting the capacities in-house is making a lot of economic sense for us.
Okay, we're going to leave it on that note, Gaurav. Thanks very much for joining in and speaking with us. So that is Jindal Worldwide talking about their business. They do expect an up move in margins. They do have an EV arm,